Invesco.com.
Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. It is often said that software has eaten the world, but it isn't the only investable asset. Some are arguing that hard assets like real estate and infrastructure are an important diversifier away from technology. Let's talk with Dan Foley, CBRE Investment Management Portfolio Manager for the newly launched IQ CBRE Real Estate at Real Assets ETF. I know that's a mouthful, folks. I'm going to explain it.
Somebody in trouble, you
want
to catch this, though, when you do it right. It's like, bro, you fell asleep in here, man. We're going to catch an article for that when we're supposed to oscillate. Now, that happens, and maybe the comms were like, who knows how they rolled up on them.
So,
but
Dan, you
maybe
launched
they just
this
did. I have to have
new
you with the
ETF a
camera
month
on
ago
there
in the
and
midst
see
of
how
a tech
that was.
frenzy. Yep. Not great timing, but you did it. You say inflation makes hard assets a great investment. Can you make the case why now? Why hard assets?
Right now,
yeah, look, we think investors are coming to the asset class to have inflation protection. We're seeing large institutions globally enter this space. We think retail investors should be too. We think that the ETF market is lacking
the town over,
options
the kids
in this
over
space.
here on
and
this
frankly,
one.
we just think there's a lot of opportunity here with secular changes in things like digital transformation,
sacrifice or
decarbonization, and then just frankly mispricing in the market. So the
but it could have gone
opportunity
the other way. It just happened to go that way, and that's why you can't.
Potential in our opinion.
This is track here. We're showing this now. This is brand new, so it's got a month of history. But this is you back tested it. Does this track things? Does it track REITs? Does it track commodities? Is there anything? What are you following?
Sure. So at CBRE Investment Management, we have a history that goes back in the REIT space, back into the mid-1980s. We've been live with infrastructure strategies for over a decade, so we have quite a bit of history here, and of course, an investment management platform that is nearly $150 billion in scale, operating within this real asset space. So we have a lot of history here, a lot of expertise and boots on the ground. We think this is important for investors. And we do think that over time, this has been one of the most attractively positioned segments of the real asset universe. And we think there are a number of opportunities that make that true in the go forward as well.
So we've seen higher interest rates in the last week. It seems to be impacting real estate. REITs have had a rougher time this week. They're underperformers. We had Nassim Taleb on, the author of The Black Swan. He was on this morning on Squawk Box. He said, be careful about real estate, because it can be unstable due to the higher rates. Does it concern you, or are you in a different kind of space than he's talking about, generic real estate space?
Yeah, look, I think valuations are very compelling. So I would take the other side of that and look at the opportunity on the other side. Right? History has told us that when you get parts of the real assets universe, like real estate, trading at 20% discounts, the go forward provides 15 to 20% returns. That's a history lesson, but we think the elements are in place for a pretty strong total return going forward. And within the infrastructure space, you have a very different dynamic of very stable assets. Right, you turn on the lights in the morning, you brush your teeth with the water, you get on an airplane or you ride the train like I did this morning. These assets have a very different cash flow, stable cash flow profile, and they're also the assets that are enabling the digital economy, data centers, cell towers, right?
For the kid, they needed this version
decarbonization, right? You need these leading infrastructure companies that make that investment, and it's driving growth that we think will drive a differentiated outcome.
I want to get to what's in this fund, but Tom, I want to get you in here. Your thoughts on the hard assets. We've heard this play before here. Is there a case now for owning them, or owning them still, or continuing to own?
Well, in the last couple of years, Bob, as you know, as the market's been challenged, 1/3 of advisors have had 10 to 20% of their allocation in alternatives in some of these areas. Obviously, energy was a great performer. It's come back down and settled. But if you look at REITs, for example,
John
office
the Warrior
buildings,
Poet's going to have to figure this
retail,
one out. But me on the turn, I got to
also
drive
there's some other areas, and that's why I like
Society
this
a
is
little
actively
bit.
managed.
So,
If you have areas
23
like
counties,
healthcare,
or 23
data
districts,
centers,
64
or
counties,
areas,
and that
like
is a force
residential,
multiple
which is
across
in demand right
the
now.
mean
You
greenage
kind of pick
on
your
this thing.
spots, is that right?
Yeah, well, look, if you think about, I think it's a bit of a misnomer when you read the headlines. What is the REIT sector, right?
Yeah.
The REIT sector today is a lot different from the REIT sector prior to the global financial crisis, right? Nearly 60% of the investment universe are what we call next generation type real estate assets, right? Where the private equity players, where new allocations are coming in, that's things like self-storage, some of the areas that you mentioned, things like single family for rent, right? The cash flow growth and outlook trajectory of these entities very different. But they've all suffered with the REIT sector in a rate environment. So we think the valuation dynamic today is incredibly compelling.
You know, Tom, there are other hard asset ETFs that are out there. We've covered them here. Van Eck, our old friend, Jan, he has got a natural resources ETF that holds basic materials with an emphasis on energy. That's out there. There's Flex Shares. They have a global upstream natural resources index, another one I can't pronounce. Gunner, right? G-U-N-R. They have water and timber. Look, here's a little list here, along with positions in companies in energy productions and metals extraction and agriculture. And then there's the old stalwart. There's the Vanguard Real Estate Fund. It's REITs. So there are other choices out there, Tom.
There are, Bob. And in ETFs, there are tons of choices. The whole idea is you got to lift up the hood and see what's inside. Areas like Gunner and Van Eck were very heavy on energy, so they did really well in the last couple of years. Recently, it's come down a little bit, so that's important to see. But areas like agriculture, where you can kind of pick your spots. Base metals, there are ETFs out there that represent all those areas, so you can be very, very selective. But the idea is if you're going to have an
that person is supposed to be in charge of it. Bill,
hard
you
asset,
might be right that
you need to understand A, is the manager have a fixed index, or is it going to be an active strategy, and they've got a history of being doing a good job as far as
this is an active strategy. But this is a differentiator, though. When you mentioned energy, commodities, essentially, that's what's not here, though. So I see infrastructure companies. Let's put up what we've got in some of this. I see infrastructure companies like Crown Castle, and those who don't know, they do cell phone towers, fiber optics. I see real estate companies here like Public Storage. We all know them. They do storage. Then we have utilities. There's NextEra, I see there. WC Energy is a utility company. Equinix, we had the CEO on this morning. That's huge in data centers. Sun Communities is also there. They do manufactured housing, I guess. What I don't see here is commodities. I don't see Freeport McMoran. I mean, it's a copper. They're producer. It's a hard asset. I don't see oil stocks. Explain why commodities are left out of what we think of the natural hard asset.
When we approached the marketplace and we kind of looked at the landscape, what's out there, what can investors get? There was a very wide field of real assets. And not only what are they investing in, right? What segments of the universe are they investing in, but in what flavor? Are they equities? Are they debt? Are they a mix? How are they making these allocations? And frankly, if you do the historical analysis, the risks and returns are so-so, right? And so we think that the opportunity, again, is more focused in these areas that have secular trends, like I mentioned earlier, with digital transformation. Equinix is a great example of a world-leading entity. Just had a great investor day yesterday, 7 to 10% growth, growing the dividend 10%. That's the kind of assets you want. These are essential to the new economy, right? And you can get that, we believe, at a discount. So we believe that, focusing on the areas of real assets that we are focused on provide more opportunity and a differentiated view from what's in the marketplace today.
So do you think, I guess, Tom, I'm just having a
usage of spies.
It makes sense to own infrastructure, for example. So you can argue in the REIT space, you don't want to own maybe apartments now, or you don't want to own office spaces, but you want to own infrastructure. You want to own Equinix, you want to own Public Storage, you want to own warehousing. There's been some niches in the REIT industry that we've been playing with for 20 years. I mean, the industry knows this, right? And you can actually have tactical asset allocation within the REIT industry.
Well, you're right. So you're mentioning tactical asset allocation. We're in surveying advisors, Bob, in the last couple of years, almost 2/3 of advisors have taken money off the table in the traditional 60-40. And what they're doing is looking for either stick it in cash, $6 trillion in money market funds these days, or they're buying alternative strategies, and in many cases it's going towards active managers who've got a history of doing a good job in those areas, as opposed to individually buying indexes that happen to be thinly sliced. Well, you can make a case for base metals. There are great base metal ETFs that are out there, agriculture ETFs that are out there. However, you need to make the decision on that allocation. When things are tough, advisors love to turn to active managers, and we're seeing more of the flows going into those areas.
But it's more expensive. What are we charging for this?
65 basis points.
Yeah, that's not 10 basis points.
Right. It's not. At the same time, if you're an advisor and all you're doing is indexing, during those tough times and you look on your bench for help and managers, those indexes aren't going to provide that. So what we're doing now is we're seeing, hey, we've gone through some of these tough times. What's going to get us out of this? What does it look like a year from now as we've had rising interest rates?
Up and we didn't even speak their language seriously. I see. That's curveball, but
that's really important. And then most importantly, where can you diversify? That if we happen to see an equity pullback, or as rates are rising and bonds still aren't making any money, where can you go to actually have some stability?
Interest rates, you mentioned interest rates. Let me ask you the 30,000-foot question. Interest rates are creeping up. What, if any, impact is this going to have on the overall ETF market? Where do you see, we're not blowing out, but you see 1- and 2-year yields, they're trading towards the high end of their recent ranges.
Right.
People are a little concerned it might break out, and that could slow down the rally we've been seeing, the overall rally.
It absolutely can, but a couple of things that we're seeing, you can see this by the flows. The average advisor today feels a year from now rates will be lower. So what they're doing is, although you're getting 5+% in money market funds or short-term treasuries, that's great. They don't think that's going to be available a year from now, so they're going longer duration. They're going into higher credit quality types of ETFs. They're using more active managers as well, with the idea that, I mean, it's tough to believe,
that the guard
but
didn't want to accept them as guards anyways about what it would be Leonidas and Xerxes. The coin is the coin is the coin based on what it is. Any wolf coming in Yellowstone here.
Inflation is still something that's not under control, right?
Dan, CBRE is a long history. I was the real estate correspondent for CNBC 30 years ago, more than 30 years ago. Yes, I am that old. Thank you for asking. I used to cover it. This is Coldwell Banker, all those old companies that are out there.
I broke that seal.
Is this your CBRE's first foray into ETFs? You've got a label here. I know you're partnering with Index IQ.
Yeah, we've partnered with Index IQ and New York Life Investments.
Law for us.
That was our distribution partner. This is our first active ETF. We did launch a passive ETF roof last year, so that's dedicated specifically within the real estate space. So yes, relatively new. But we, again, think that there's an opportunity here because real assets in the ETF market are, a pittance of where the capital is, right? Mostly still sitting in open-end mutual funds in the market. Again, as I noted, somewhat mixed return and risk profiles over time. So we think, one, you need to be active. There's an opportunity in the ETF market, and you need to be active because policy risks, thinking about just real estate. Yes, there are risks. How can you avoid those risks and go after the right opportunities globally? And how do you think about infrastructure assets, which do have a regulatory and policy dynamic that you have to understand, right? That's where you want institutional level expertise, and that's what we bring to the table.